So what does it mean for the market going forward? Let's ask NewEdge Wealth's Cameron Dawson and Palumbo Wealth Management's Phil Palumbo, both here at Post 9. Welcome to you both. It's interesting, Cam, because like 2.5 weeks ago, the market had a little bit of a panic on a perceived re-escalation of trade tensions. We got sort of a status quo type of a truce. Market seems to have moved on to, are earnings good enough? What does positioning look like? And did we get too overexposed to semis and mega cap tech? And now we're trying to undo it.
I mean, in so many ways, markets moved on effectively in mid-April. And I think the key reason is that for all the fears around tariffs, you really haven't seen it hit earnings in aggregate, meaning that, yes, there are pockets of companies that are certainly feeling the pinch from tariffs. Certainly Chipotle today is an example of that. But the reality is that in aggregate, earnings are continuing to make new 12-month forward highs, which just suggests that because we have this AI capex spend that's driving so much earnings growth and driving the majority of earnings growth, the markets have been able to drift higher. Today, of course, the reaction about Meta, I think the key question to ask is, will this cause Meta, today's reaction, or a weaker stock price to potentially pull back on capex into 2026? And if that happens, we'd probably have bigger things to worry about.
Yeah, I don't think the market is necessarily willing or ready to make that leap at this point. Phil, what about the general setup here? I mean, obviously, you've kind of had a good year. The history books and all the patterns say it should continue to be pretty good into the end of this year. And working against that is maybe some concentration risk and valuation.
Yeah, so I try not to think myopically, which I think is really important, right? So the whole talk about, are we in a bubble, right? So when everybody's saying that we're in a bubble, normally the opposite happens. So when you think about situation today versus 1999, in 1999, Cisco was trading at a forward multiple of over 200 times. You had Intel trading over 100, 200 times. Today you have the Mag 7 minus Tesla on average 35 to 38 times. So valuations are reasonable. And then back in 1999, October 1999 to March of 2000, the NASDAQ doubled, right? So we're not in that euphoric time right now. So people can't be myopic. This is the biggest movement in terms of AI that we ever seen in this country. And a lot of these companies will continue to perform like we're continuing to see yesterday and continue to see today. Yeah,
we'll see what the reactions are, at least in the short term, to Amazon and Apple after the close. Guys, stick with me for a moment. We're going to get on to another one of the big drivers of this market. Investors closely watching the Fed and what December might bring. CNBC senior economics correspondent Steve Leisman joins us now. Steve, one day later.
Yeah, colder gifts, I guess, is the way to think about it. Markets continue to price in, Mike, a December rate cut, and that despite the aggressive pushback yesterday from Fed Chair Powell. Take a look at the numbers here. The probability of a cut in December, now at 71%, or I should say still at 71%, down from 84% yesterday, but it was 64% after Powell came back. Still a fairly confident trader. Several major Wall Street Fed watchers also continue to call for a cut, despite being surprised by Powell's hawkish tone at the press conference. Goldman Sachs writing, we still think a December cut is quite likely because the September dots implied that most participants saw it as the baseline. The labor market data are unlikely to send a convincingly reassuring message by the December meeting, and Powell sees the policy stance as contributing to labor market cooling. But markets, they could be relying too much on those dots and the dot plots from September. It showed a median of 3 rate cuts, but widespread disagreement you can see in the spread there. 7 of 19 members wanted just 1 cut or fewer this year. Nomura economists saying we now see a December pause as the most likely outcome. Data are likely to be modestly dovish in the months ahead, but we doubt the weakness will be sufficient to rekindle FOMC concerns about a deteriorating labor market. So where are we? In the absence of a reopening of the government, investors just need to watch this alternative data very carefully and listen closely to how Fed officials are reacting. If the divide on the committee continues, a cut may be increasingly unlikely, Mike.
All right, yes, and we'll definitely need you to parse all the Fed speak from here because we do have a lot of divergent voices, Steve. Thank you very much. So Cameron, the premise of the bull case has been we had this dovish turn from the Fed. We're going to get more rate cuts, and it's an economy that doesn't quite need them. But it was going to be this kind of insurance or normalization cuts. So what are the stakes when it comes to December?
Well, certainly fairly high, given the fact that if you look at the way that the market has performed since the September cut, it has had such a low quality, liquidity sensitive bent to it that would suggest that at least that cohort of the market is very, very much counting on the Fed continuing to deliver. And I think to your point, it's the fact that the market and the economy doesn't necessarily need these cuts, which is why they have been bullish. But I think the challenge you have is that if you are cheering for a lot more cuts, you are effectively implying that the labor market is, in fact, far weaker than what is suggested by the headline numbers, and that growth estimates are too high, which means that an equity market trading at 22.9 times and credit spreads at 20-year tights would be very aggressive. So you really want to cheer for that middle of the road, a couple of tweaking cuts lower, but not necessarily anything much more than that because of the implications for growth.